The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. From improving emergency response times to protecting against cyber attacks, local, state, and federal governments are innovating with Google AI. This is a new era of American innovation. Find out more at g.co/American Innovation.
Reality radio for a really great future. We're talking real money.
Wow! The view from up here is amazing! I don't remember being this high before. Don't look down, though. Do not look down, because at these dizzying heights, what comes on the other side of the peak could be scary, right? We're not talking about mountain climbing here on Talking Real Money because the show's called Talking Real Money. We would not talk about mountain climbing unless there was a reward in it somehow. Financial. Remuneration. That's one of those hard words, isn't it? Hi, everybody. I'm Don McDonald. Clear up here on the top of the market and looking up from below. But, he's almost here. Yes, here he comes. Tom
As a guy
Cook.
who did just do some mountain climbing recently, let me tell you, it takes me a long time to get from here to the top.
Did your buddies beat you up the mountain?
Oh, God, it was
up Mount
embarrassing.
Rainier?
One guy's one leg. He's going faster than me.
He's on one leg hopping up the mountain, and Tom's going,
Yeah.
I can't do
I know.
this.
And they're like, aren't you the Stairmaster guy, the referee? I'm like, yeah, but this is different. It's a 6,000 feet. I don't know. Yeah, I wasn't. Nah, I didn't show myself
They
well.
neglected to build stairs into Mount Rainier.
They did for part of it, but not all of it. So sadly, anyway,
right.
good time.
Yeah,
but,
markets, a lot of people are starting to get a little worried about the frothy, peaky, high markets we're experiencing right now. And they are a bit high, aren't they?
They really are. When you look at, for example, price to earnings ratios, they're not quite at a record, but listen to the numbers. The S&P 500. Now remember, the S&P 500.
I know, it's just the S&P 500.
We'll get to that in a moment. Currently trades
better than the Dow. Better
20
than the Dow.
22.5 times its projected earnings over the next 12 months. Now, that compares to an average of 16.8 times since 2000. So that's about a 25%, delta.
And this is
that's pretty
future
decent.
earnings you're talking
Correct,
about,
yeah.
projected over the next 12 months. Okay.
And the 10 largest companies in the S&P 500 now account for almost 40% of its total value. That is the most ever, according to Morningstar.
And guess which companies those are, folks. We'll just leave that to you. You know.
Yeah, you know the names. But investors are saying that's worth every penny because, well, the aforementioned companies, NVIDIA and Microsoft, they're boosting sales and profits at a rapid rate. And by the way, if you took those companies in the S&P 500 and evenly weighted them, said, you get this percent, you get this percent, the index would be trading at about 1.76 times sales. That compares to a long-term average of about 1.5. So that wouldn't be nearly as dramatic as you get in the price-earnings ratio. The point is, yeah, things have gone up. They've gone up a lot. But what does that really mean in terms of the future? That's the part that nobody knows. I can tell you what it means in terms of today.
Yeah.
What
does it mean in terms of today?
Well, it means, guess what? Ma and Pa are home trading. It's crazy.
Ma and Pa, I thought the kids were doing it.
Well, it must be the kids then, because so for example, now generally in the last 20 years, retail traders make up about 10% of the stock market trades. It's about somewhere around 10. It goes up, it goes down, but it's gone up a lot. Now, retail traders recently number about 18% of trades. They're home or on the road or wherever on Mount Rainier, wherever they are, they're trading, and they've been trading, those meme stocks again, and crypto and options, exchange traded funds. They're all moving stuff around, which is great news. If you're somebody like Robinhood or Charles Schwab, because guess what? They're making money on a lot of those trades. And individual investors poured another $155 billion into stocks and exchange traded funds in the first half of the year. Margin. Remember margin?
Yeah, that's borrowing money.
Yeah, it's insanity. Margin debit balances have never been higher. Never been higher. I mean, you go back to, I think
Wait,
that's
never? No, hold
I think
on.
not in terms of percentage, but I think in terms of the dollar amount.
Okay, because I was going to say, in terms of percentage, nothing
higher
beats
in the 20s.
The 20s, right?
Yeah, way higher.
Because they could go to 90% margin back
exactly, which is why you had people jumping out of windows, falling out of windows. Yeah, there's been a huge wave of retail trading, and the brokers are loving it. They're eating it up. And by the way, 81% of Robinhood users expect markets to continue climbing in the third quarter. That wouldn't surprise you that the people that are doing the trading think it's only going to go up.
Well, you hear the same thing from people who are buying gold or crypto. Well, it's going to go up.
Yeah, it has to, right? Because it's gone up. So it's an interesting time because you have the other current to all of this, of course, is the question of sort of where is the economy headed? I mean, right? Because we had some little difficult signs from the labor market, right? We've had the fact that inflation sort of stubbornly remaining high. You still have the whether we're going to have high tariffs or not situation, whether the courts are going to throw everything, and nobody really knows. So, yeah, well, stocks are up significantly. I'm not sure what that all means, Don, to you.
Well, that's the point. People are asking, what does that mean? What should I do when stocks are hovering at these ridiculously high levels? Should I get out? Should I change my portfolio? Do I bail and go into bonds for a while? What is my strategy as an individual?
Yeah, and this is the part that we've had the same basic message for somewhere around 30 years. And that is, as always, you have a plan. Your portfolio matches that plan. You're able to tune out all the stuff that comes along because the next week, by the way, may all be good news, right? I mean, there may be more economic numbers that look good, and we may get the rate cut we're talking about, all those things, and the tariffs get thrown out, whatever it is, and people say, such great relief. I was so worried about September, but turns out it's okay. So for you listening to this, you already have built in the fact that markets, stock markets, sometimes bond markets, will go down. It's going to happen, and you're ready for it.
Wait, they have? Our entire audience has done that?
I'm just hoping that they're paying that close attention.
Oh, that was a wishful thinking statement.
Hope is not a
strategy.
strategy.
No, the answer is we know. Now, we know a lot of you who have listened regularly have gotten this right and have built a really well-diversified portfolio. But, Tom, come on. We also know that a lot of people who listen regularly have the traditional American portfolio, which, as of recent numbers, shows that about 80% of the money in investment portfolios of all kinds is invested in U.S. large company stocks. 80%.
Let's say it again. Let's say it again. 8 out of $10 is basically in the S&P 500.
You got it.
Yeah.
Basically in the S&P 500.
So that's
somewhere between 70 and 80, but 80 is at the high end.
We'll say 80. But that is the reason I worry about people is all those numbers we just mentioned about things appearing to be overpriced, which we're not going to say because I think the price is the price. That's the part of the market that has the potential for the biggest fall due to the fact that it's gone up the most. I'm not saying it will. I'm not saying it's going to happen.
We're not predicting because we don't do that.
Nope, we don't know. We're not one of those people. But I can tell you that if your portfolio is centered there, as most are, we just talked to another guy today who sent us this stuff, said, hey, I follow your models, et cetera, and he had about 70% in large U.S. firms. Like, you want to have some small in there?
I only buy the stocks that went up.
Exactly.
See, that's the thing. You can't say only buy the stocks that go up because you don't know what the stocks that go up are going to be. All you can do as a regular investor is buy the stocks that went up, and that's not a great strategy.
No, you want to own them before they go up. So back to this. There are parts of the market, if you really want to make sure that you're covering your bases around the things that have not gone up as much or not as expensive, then yes, you're going to own smaller companies. You've got to throw some of those value firms in there. You want to be internationally invested, again, with big and small, growth and value. You want to hold emerging markets, which most of you don't. And there's a significant number of stocks you could own there. But I will add one other thing, because I'm more troubled in some ways by the fact that so many people are trading stocks and trading ETFs and buying and selling crypto, because Eugene Fama said it very well once, and I'm gonna probably mess this up a little bit, but he said trading is like using soap. The more you use it, the less you have. In other words, you rub your hands together with the soap, and you just end up with less and less and less money. So the people who are trading,
because of the friction of fees,
and it's going to use it up. I will also add that we've seen this. Yeah, we've seen this right here. Every bull market sees these high trading volumes. You can go back and look at the numbers, and it does very well until it doesn't. It ends poorly. And I would urge anyone who's trading, anyone who's saying, all the things we've just tried to disabuse you of, the future, anybody who thinks they do, I'd say, what do you know more about the future that somebody else doesn't? That's the way I'd put it, because remember, all those trades that you're making still go up against all the institutional trades, the smart people that run mutual funds and exchange traded funds, and they have millions of dollars to analyze this, not to mention AI, et cetera. But that's the part that worries me with markets high and lots of trading, that people could really get themselves into trouble here, Don, in ways that we've seen end very, very poorly.
Yeah. So here's the thing. You need to stop doing a lot of the things you've been doing and really, truly save yourself both a lot of time, money, grief, and future losses by just taking a very simple path forward, and that is properly diversifying your portfolio. And there isn't a number that's right for everybody. It's based on your needs and your risk profile. Those two things. That's the formula. Diversification, needs, risk profile.
Yeah. And by the way, if you do that, if it's important to be competitive in all this, you're going to end up above about 95% of the other investors. If that's important to you, because a lot of times it is.
Because
I want to do better than my neighbor.
Most investors underperform, despite their efforts to the contrary to outperform. Most investors, Oh, and I know you're going to be the special one.
You're above average.
Yeah, you're going to be the special one who doesn't lose. Right. It's kind of like our love of apocalyptic stories. You know how we watch apocalyptic movies and read apocalyptic?
Yep.
Because in our minds, we imagine we're that one person who survives, that 1 out of 100,000 or 1 out of 1,000,000. I'll be the one, driving in all the cars that are left after the apocalypse eating all the canned food in the grocery store.
When are they going to have the post-apocalyptic movie that shows how happy and how nicely everything turns out? I'm waiting for that one.
That wouldn't be an apocalypse now, would it?
Every time I look, let me guess. Another apocalypse. Yeah, okay.
That would be a utopian movie.
Okay,
and those
I need a little more of that.
Those tend not to do really well at the box office.
No one wants to watch the happy times.
No, pretty much no. No, I mean, even in The Wizard of Oz, they kill people.
Good point. All right, let's go to your questions, which come in from talkingrealmoney.com. And click on Contact Us and send them in. And you can read them into Don, who will put them on Fridays.
And I need more of those, by the way. I'm a little low.
Yeah. So dial up. Well, no, you don't actually dial. You go to Contact Us.
Go to the contact form and you click the mic button.
I've never done it. I'm going to have to do a surprise one.
No, don't do it. Don't even. It'll just come through to me and I'll have to be annoyed.
What in the heck is this?
All right, what do you got for us?
He'll know because I've tried voices on him. It never works. Peter from Agawam, Massachusetts.
Well, that's a pretty good try.
Yeah.
Go ahead.
Says, my 18-year-old son just started investing, and my uncle, here's the important part, who is a CFO at an investment company, helped him with his allocation. Right now, here's the portfolio. 40% in FSKAX, which is the total U.S.
Okay.
40% in the FSPGX, which is U.S. large cap.
I think he works for Fidelity.
And 20% in the FTIHX, which is international. Mm-hmm. So since he's young, has a long time horizon, is this the appropriate mix of funds for growth? Would you recommend broader diversification? Yeah. Didn't we just mention something about people being too focused in large companies? Because basically 80% of your money is now in the FSKAX. They got a little bit of small. and maybe a tiny bit of value.
Its portfolio is a lot like VT, the Vanguard Total World Index,
which is
okay.
Yeah, it's okay.
Again, don't be too critical.
But this is the part that's going to get the real meltdown. Is my worry that the kid's going to get the money and go, wait, it went down by 30%. Yeah, it went so. No, this is not
what
how
I don't
would do
understand. See, I was okay with FSKAX.
And then just
it's
the international.
FSPGX.
Yeah, just adding more large cap to a portfolio dominated by large cap.
And I'm confident I know why the uncle is suggesting that, because those are the stocks that have gone up.
Yeah, gone up a lot. So, okay, but maybe what you could do, first of all, I think the international exposure is underweighted here at 20%.
Way under, yes.
Yeah,
yes.
I would take that to probably at least 40%, right? So now you still have, I'm okay with 40% in FSKAX, 40% in the FTIHX. Then I'd probably do an extended market or something with the other part, because that would give you some more small.
Well, I would probably do, just because if we keep it in Fidelity and we want to keep it with indexes, which we do, I would look at the Fidelity Small Cap Value Index, which is FISVX.
Yeah, take the remaining part of that. So you're still looking at
take the FSPGX
20%.
And move that to the small cap.
Then you're still underweight to international. I'd rather see international doubled up at 20% too low, 40% probably better.
I think 40% is a lovely number.
Yeah, and then you could divide
take some of the total market.
Yeah, well, you could just divide the money between the two of them, the total and the small, if you wanted to.
Yeah, there you go.
All right.
That's a good answer.
Thank you, Peter, for the question. This one is from Nylish in San Diego, California. Hi, Don and Tom. I'm in my early 30s. Have about $100,000 in total retirement savings. Wow, that's great. I took the Appella risk quiz and received a risk tolerance score of 67. Kind of low for somebody that's 30.
That is a low number for somebody that young.
I want to know what you think of the following asset allocation for somebody like me. All right, here we go. There's a lot of stuff here.
Oh, geez. See, these
50% in the VTI, which is the total market, right?
Total U.S.
Total U.S., yeah. 15% in AVUV, which is U.S. small cap value. 15% in VXUS, which is international. 10% in AVDV, which is international small cap value. And 10% in AVEM, which is emerging markets. So he's wondering, he's going to hold all those in his Roth.
That's aggressive for a 67.
That was my first take. What your score is telling you is, while you may be young and you want to take risk, you may not be able to take it.
What your score says is you need about 30% in bonds.
That would be my take. So that would be the starting place, to first rearrange your overall asset allocation to include some fixed income that will give you cushion from the next big bad bear market.
Otherwise, for the equity portion of the portfolio, that's great diversification.
It is. He says he used ChatGPT and DeepSeek to perform a back test on these asset classes using Fama French. Received a CAGR. In my 30s, I wasn't thinking about this CAGR, of 11.2 and standard deviation of 17.8, which is pretty good from 72 through July 2025. That's good, and that's good work.
Yeah, I would be tempted to retake the risk quiz just to see if maybe you were just in a weird mood that day.
Yeah, and by the way, you can come by here. We have the version with the electrodes. We really get accurate scores with that.
Right, because if you lie, it shocks you. So it combines a risk quiz with a lie detector? With an electric chair.
Say yes.
With an electric chair.
Electric chair for the people that we
really... it's not that bad. It's more, it's.
So, no, I agree with Don. So, okay, you're right. Let's do this. Let's retake the risk quiz. By the way, you can go to talkingrealmoney.com and click on risk quiz. Because that's a different one than the Appella risk quiz, I believe. I don't know. There's more than one risk quiz.
I think they're from the same source. But
all right, but go take the risk quiz again. You're right. Maybe you were in a weird mood or, whatever. You'd been out at the Kager the night before.
Yeah, because I would put somebody in their 30s, generally speaking, they're going to be in their high 70s on the risk quiz.
Yeah, I would like to see you in your 30s probably just be in a 90-10 portfolio.
But not with a 67 risk quiz score.
That's off the chart. So, retake it and then adjust it. So we're okay with the funds you picked here, which is, as he points out, is good. You also have some factor diversification there. First decide on the stock-to-bond ratio and then divide it up with those other funds. That's pretty good. Yeah.
Yeah, I like
that. Make sense?
That makes sense.
We'll get time to squeeze in one more. I think you're going to like this one.
We're in good shape. Yes.
Okay. I think you're really going to like this one.
I'm so excited. I've been looking forward to this one all day.
You don't have no idea.
I have no idea what it is, but I've been looking forward to it.
It's Jay from Atlanta. I want to thank all of you in Georgia who have been listening to us lately, too, by the way. Especially
Jay in Hotlanta, Georgia.
Somebody's listening a lot in Savannah, Georgia, for some reason.
We did have a lot of
list.
listeners in Savannah for some reason. I don't know what happened there.
Anyway, but thank you all. Hi, Tom, and Roxy. Okay.
Oh.
Really? No, that's nice. Okay, my wife asked me about an investment opportunity at www.investwithroots.com. You mean Roots, the TV show? I was hoping to get your take on it.
It's a potato farm REIT.
I'm looking at. I'm not looking too favorably at it, seeing that this is not a normal market trading investment. They only allow divesting once a quarter. They ask you to keep your money in for 12 months, and they charge an 8% fee. 8%?
Well, no. Okay, he wasn't reading it. He wasn't.
My wife is getting the good feels when looking at their website. Me, I'm likely to stick with my AVG, EDFAW, and BND mix. Pardon me.
Well, here's the first. I dug through their website because you warned me about this. We were playing around.
I did give him a little heads up because
I went and looked, and they're claiming in the last 12 months they returned over 12%.
But
so my first rule
are these audited returns?
I don't know. My first rule is if it sounds better than the stock market, run away. Yep, always.
Because
run
why
away.
Would there be a stock market if you could just make an easy 12?
Right.
Yeah.
Right. Now they tell you, they give you quarterly liquidity. That's where the 8% comes in. If you try to get out in the first year, they'll charge you 8%. I did some checking on their other fees. And,
okay, but wait. Stepping back, what is your money invested in?
Oh, it's invested in rental properties.
Well, that's always easy money.
Rental properties in Atlanta and Augusta, Georgia, and that's it. So it's geographically limited, very limited.
So can we call this a REIT?
Yeah, it's an A+ REIT, which means it's it's not available. It's got some restrictions on it, but here's my concern. Really, my concern is not just the geographical limitation, but the fact that they're making claims that give me that tingly feeling of so many of these bad real estate deals in the past that have either collapsed completely, were semi-legitimate but collapsed, or were outright Ponzi schemes, Tom. And you know, we had one on the show. You know about another one really well. Yeah. These, you don't know what's wrong with them until they go bad.
But is this the one where they're offering the people who are the renters an opportunity as well?
That's just so wacky.
Part of your rental payment goes into the thing.
If you're a good renter, it's called the Live in It Like You Own It program. If you're a good renter, you earn quarterly rebates in shares of the fund if they take good care of their property and pay the rent on time.
Wow.
So it's sort of it's shown as a win-win. Now,
invest in yourself. Yeah.
My problem is I'm trying to figure out where they can get these 12% returns in a market that generally doesn't generate those after all the other expenses. Because bear in mind, they have a 10% property management fee. They have a repairs and maintenance fee. They have an acquisition fee of 3% when they buy property, a disposition fee of 3% when they sell property. They get $500 from every lease. It's just they got all these nickel and dimey things going on that suck down their return on the rent. And rental properties haven't been all that lucrative. And what happens if the Augusta, well, primarily the Atlanta market, goes south?
What and how big?
It was kind of a joke.
Funny,
yeah.
Okay. How
much further
big
south
is the
can
fund?
they go?
Yeah.
What?
How
what was your
big
question?
is the fund? Couldn't tell.
They don't say it.
Okay. This is private,
see.
right? This is not publicly traded.
Yeah, right.
Either.
This is not publicly traded.
But thank you, because you buried the lead. In my mind, you could go own a REIT. Vanguard's got a very fine one where you could own a lot of different type of properties, including apartments, for less money, greater liquidity, way better diversification. That's where I would go. Oh, by the way, they're not the only ones who own REIT, but they have
but they have a really extraordinary degree of diversification in their, like VNQ, which is their ETF, which has, by the way, total fees and expenses of 0.13%.
Yeah.
But here's the thing: what has been the historic return on Vanguard's very diversified REIT that is invested in the finest real estate investment trusts in America? I mean, we're
what
talking
period of time?
10 years, 15 years, pick a time.
Oh, in 15 years, what's been the annualized
What's been the
return?
Average annual return? And these guys, remember, they're claiming they could do 12.
Yeah.
What has a real live REIT return?
In that period of time, like 8%.
7.85. You're so close.
Look at me. So, yeah. And I trust that number, whereas I don't trust somebody who's in a private REIT telling me 12%. I'm sorry.
Right. And you don't have the wherewithal to audit them. You cannot trust that their audits are good. You can't. No matter what they say, you cannot believe them, because when it comes to money, people lie. Right? A lot. Don't trust anybody. Don't. And don't get into anything that claims 10+% returns. I don't care what Dave Ramsey says.
Oh, God's sakes. You had to drag him because
I was in the South.
Yeah, there you go. Drop him by. Take Dave down while we're here. All right. Those are great questions. Keep them coming. As Don said, he's running a little low on the spoken questions. So you go to talkingrealmoney.com, click on Contact Us, click the microphone, and speak away.
Those go on the Friday question and answer show. Otherwise, the typed ones go here or there or over there. And, oh, by the way, the other thing you can do, too, is if you want to just talk with us, like ask a question and we can respond, and then you can respond, we can have a conversation on a Saturday, because every Saturday, Tom and I spend 2 hours talking with you on our radio show in Seattle that becomes a podcast. And that number, 855-935-TALK, call right around 3 p.m. Eastern time.
Yeah, we love talking to other parts of the country on that day while we're talking to Seattle. So
in
great.
Other parts of the world.
I know. Well, that's a good point. Canada,
we had Denmark once.
We did have Denmark once. And thank you all for listening, because the numbers, which we look at every month, have been amazing. The number of people that are downloading the show, where they're down
a little bit recently.
Oh, okay. So listen more.
Because of the holidays. I think the holidays slowed us down.
For God's sake.
But tell a friend or two, or 1,000.
Okay. We'll take it.
And by the way, you may not have 1,000 direct friends, but for those of you on social media, you may have 1,000 friends there. And if you suggest Talking Real Money on your social media, it's like telling 1,000 friends. See?
Your wife, how many friends does your wife have on?
Don't ask.
Facebook, Meta, whatever.
The good news is she hasn't been contributing as much as she used to.
She was awesome on there. I don't read it, but my wife would tell me, "Hey, look what Debbie just posted."
Look what Debbie.
Don
your
has
wife
a hangnail.
Too.
Yeah, okay, yes. I try not to pay attention to that as well. Thank you.
Goes your. Well, but fair is fair.
I hate it when people tell me, "Hey, you had a great time with." I'm like, "How'd you know?"
Now, come on.
What?
Be fair. Be honest. Do we talk about them on our show?
Never.
You liar. We do too. We're like sitting here on Saturday going, I hope they're not listening. I think we just said something.
I know. It comes back. It all comes back.
Yeah. Oh, I'm going to plug my other podcast because we have 1 minute.
Oh, please.
Go to my short story podcast. It's back with a vengeance. New story every week. Every week, I'm putting up a classic short story. And in the next few weeks, I'm going to have a big surprise for everybody, a big first
is
coming
awesome.
up on Lit
I
Reading.
gotta say,
I mean, it's a big first.
Yeah, I agree.
So go to your favorite podcast service and listen to Lit Reading, L-I-T, Tom.
Yes, thank
reading,
you.
as in
No bad
reading
jokes.
literature.
Got it.
Got it? Lit reading.
Read my lits. Got it.
Read my lits. I read lits. I'm the one.
I got it.
I read the stories, and people like them. I've got like
Good.
I've got like 4.9 stars on Apple, which is much better than Talking Real Money has.
It's okay to be a big lefty the way you are on lip reading.
I'm not a
big lefty. Oh, that's it.
Only in the world of
today's
Fox
world.
News am I a lefty.
Yeah.
I used to be a righty.
I think I said big lefty, I think is what I said.
I used to be a little righty.
I know.
I did. You know I was.
I feel bad for you. So you know
so
that.
hard.
Somebody just called us both lefties, so that's okay.
Oh, there's no way you're a lefty.
If I am,
just no
then
chance.
The world is definitely.
This is why Tom will never go into Seattle. He's afraid.
I was just there a couple days ago.
In Seattle proper?
Well, we're
you went. Yeah, but you went to a sporting event. It's safety in numbers.
I had to go beat up a couple of Inter Miami fans. So
did you punch some guys in pink?
Absolutely. just for the point of it. You know me. Looking for fun.
There was a fight at the game.
God,
all right, 30 minutes. That's it. That's as long as these podcasts can go. Thank you all for being there, and please join us all the time on whatever podcast service, whenever, because, it's important stuff. We're talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor.
Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services.
Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.
Every minute your finance team spends wrestling with data is a minute lost. Insight Software's AI-powered insights instantly move you from complexity to clarity. Automated analysis, real-time reporting, strategic recommendations, all at your fingertips. Transform how your finance team works and watch your business grow. Stop wasting time. Start making smarter decisions. Learn more at insightsoftware.com/AI.